The strategy behind Burry's stock picks, what drives his decisions? Michael Burry is best known for predicting the 2008 financial crash, a moment in history that forever etched his name into the annals of investment legend. But beyond his fame for that singular, high-profile bet, there lies an even more intriguing aspect of Burry's career, his investment strategy. What stocks does Michael Burry really like, and what drives his decisions in the ever-changing world of financial markets? Burry's approach to stock picking is far from conventional. While many investors are driven by momentum, popular sentiment, or trendy sectors, Burry's philosophy is rooted in the meticulous, data-driven principles of value investing. And, though the stocks in his portfolio may seem odd or unexpected to the untrained eye, they reflect a unique and highly calculated perspective. At first glance, Burry's portfolio can be quite surprising. Unlike many hedge fund managers, who fill their portfolios with blue-chip stocks and high-growth tech companies, Burry's stock picks often lean toward underappreciated and misunderstood companies. These are businesses that, on the surface, might seem risky, underperforming, or even irrelevant in the broader market narrative. But to Burry, these stocks have hidden value, the value that no one is paying attention to. But what is this hidden value Burry speaks of? The answer lies in his unwavering focus on fundamentals. Unlike investors who chase headlines or momentum, Burry looks for stocks whose intrinsic value is far higher than what the market has priced them at. To Burry, a company's worth is defined by its cash flow, assets, and earnings potential, not by its stock price in the short term. His goal isn't just to ride trends, but to find businesses that have been undervalued by the market for reasons that are either temporary or based on widespread misperception. The margin of safety concept, popularized by Burry's mentor, Benjamin Graham, plays a key role in his stock selection. Burry looks for companies that are priced significantly lower than their intrinsic value. This is his margin of safety. It's a cushion, a buffer against downside risk. For Burry, investing isn't about trying to make a quick profit from short-term market movements. It's about understanding the true worth of a company and buying it for less than what it's worth, knowing that over time, the market will correct itself and the company's true value will be recognized. But while his approach may seem conservative, it's important to note that Burry doesn't just settle for stocks that are undervalued by a few percentage points. His strategy revolves around identifying companies that are in a deep undervaluation phase, often due to temporary setbacks that are misunderstood by the broader market. This allows Burry to invest with a significant margin of safety, and often at a time when nobody else is interested. So what does this look like in practice? Let's break down some of the key factors that drive Burry's decision-making process when selecting stocks. 1. Understanding the business behind the stock. Unlike many investors who rely solely on technical indicators or market sentiment, Burry's first step in analyzing a stock is always to understand the business itself. He's not just looking at numbers, he's looking at what drives those numbers. What is the company's core product or service? What are its competitive advantages? Does it have a sustainable moat, or is it vulnerable to disruption? For Burry, it's not enough to simply see undervalued stocks. The business must also have the potential to generate consistent cash flow, and there must be sustainable demand for its products or services. This is why Burry has made some contrarian investments in seemingly unsexy industries such as health insurance or agricultural companies. In these industries, Burry saw the potential for long-term stability and growth, even when the market was fixated on flashier sectors like tech or crypto. This focus on quality over popularity also means that Burry tends to shy away from speculative bubbles. Whether it's a stock market, a crypto boom, or the high-flying tech stocks that have become common fare in portfolios today, Burry's approach is much more measured. For example, while many investors poured money into hot sectors like electric vehicles, EVs, or artificial intelligence, AI, Burry resisted the urge to jump into those trends without doing his homework. In the past, he's been vocal about the overhype surrounding AI and how, often, the market values ideas far beyond their actual market potential. 2. Identifying market misperceptions. One of the most striking features of Burry's stock picks is his ability to identify market misperceptions, situations where the market has misjudged a company's prospects or potential. This can happen for a variety of reasons. It could be due to short-term problems like management changes, temporary dips in earnings, or market overreaction to news events. But how does Burry identify such opportunities in a world flooded with information? The answer is simple: extreme skepticism. Burry never buys into market hype or consensus. Instead, he takes a contrarian approach, asking himself, why does the market think this stock is undervalued or irrelevant? Burry isn't interested in hot sectors or headlines. He's interested in what the market is missing. He often makes his decisions based on the premise that the market is not properly pricing in the long-term potential of a company, despite its temporary issues. Take, for instance, his investment in GameStop, a stock that, for most investors, was a dying relic of the brick-and-mortar retail era. On the surface, GameStop appeared to have no future. But Burry saw something different. An undervalued asset with the potential for a turnaround. The company's stock had been hammered, not because it lacked value, but because investors had abandoned it due to short-sighted thinking. And as the market continued to miss the boat, Burry's investment ultimately proved to be a profitable bet. 3. The importance of long-term thinking. Another key element in Burry's stock-picking strategy is his emphasis on long-term thinking. While most investors are fixated on the next quarterly earnings report or short-term market fluctuations, Burry looks at the big picture. He's more concerned with the fundamentals of a company and its ability to generate consistent returns over the long term. When Burry invests in a stock, he's not just looking for a quick win. Instead, he's willing to wait for market sentiment to catch up with the company's intrinsic value. This patience is one of the reasons Burry often chooses stocks that are out of favor with the market at the time of his investment. Over time, he believes that market inefficiencies will correct themselves, and companies with solid fundamentals will eventually be recognized for their true worth. But how long is long-term for Burry? It's not measured in months or quarters, it's measured in years. This patient approach allows him to invest in opportunities that others have overlooked or dismissed, and ultimately, to take advantage of the reversion to the mean that almost always follows periods of overvaluation or panic. As we finish part 1 of this documentary, one thing becomes clear: Michael Burry is not just an investor, he's a student of the markets. He is constantly studying the psychology of the crowd, looking for opportunities where the market has gone astray, and investing with a long-term mindset that most modern investors seem to have forgotten. Inside Burry's portfolio, what his stock picks reveal about his mindset. Michael Burry's portfolio is not just a list of stocks. It is a map of his mind, a window into his contrarian worldview, and a reflection of his deep commitment to fundamental analysis. To understand Burry's stock choices is to understand how he sees the world, not as it appears in headlines, but as it truly is beneath the surface. In this part, we take a closer look at Burry's actual investment behaviors, the sectors he favors, the types of companies he avoids, and the deeper meaning behind the stocks he buys. And as always, remember, with Burry, nothing is random. Every stock tells a story. Let's break it down. Michael Burry's portfolio often looks strange, especially to investors who focus on hype-driven sectors or momentum trades. When you examine his holdings, you may notice something immediately: Burry does not care about popularity. If anything, he runs away from it. He's not afraid to invest in companies that seem outdated, slow, boring, forgotten, or even dying, because that's exactly where inefficiencies hide. So what types of stocks does Burry actually like? He gravitates toward industries with predictable cash flow, tangible assets, and stable long-term demand. This often leads him into sectors like insurance, retail, healthcare, agriculture, and even industrial manufacturing. And this is where Burry's genius shines: he sees value where others see decay. Take his investments in water, for example. Burry has long been vocal about the importance of water as a resource. But instead of buying water stocks directly, he invests in agricultural land with water rights in companies tied to food production. Why? Because water scarcity is predictable, inevitable, and profitable, but only if you position yourself early, before the public catches on. This is the consistent thread in Burry's thinking. He doesn't buy what's booming. He buys what's quietly essential. Consider his position in healthcare companies. Most investors chase biotech moonshots or trendy pharmaceutical names. Not Burry. He often invests in companies with boring but recurring revenue. Businesses that generate cash flow from things people need no matter what the economy looks like. He's also known for holding insurance companies, firms that thrive not because of hype but because of mathematics. Insurance is predictable. Cash flows are reliable. And valuations are often lower than they should be, which is exactly what Burry wants. But let's go deeper. 1. Why Burry avoids trendy tech stocks. One common misconception is that Burry dislikes technology. In reality, he doesn't dislike tech, he dislikes overpriced tech. He understands that tech companies can be great businesses, but he also knows the market often prices them far above their intrinsic value. So instead of chasing AI, cloud computing, EV startups, or robotics, he looks for tech companies that have been unjustly punished. Companies whose fundamentals remain strong despite temporary setbacks or negative headlines. This is why Burry occasionally buys into overlooked tech names or those experiencing short-term panic selling. But you'll rarely see him invest in high-flying growth stocks that everyone is talking about. His goal is not to ride the wave, it is to buy what the wave has crushed. Ask yourself, are you investing in what's loved, or what's ignored? That question alone separates average investors from contrarians. 2. His love for broken but fixable companies. There is a special category of stock Burry gravitates toward, distressed value. These companies often look terrible on the surface. Falling revenues. Negative press. Management issues. Debt concerns. Temporary losses. Regulatory pressure. Most investors run away from businesses like these. Burry, however, sees potential. Why? Because these companies often have tangible assets or hidden strengths that the market is ignoring. Burry understands something fundamental. The market often overreacts to bad news. If a company is fundamentally broken for structural reasons, he avoids it. But if a company is temporarily broken for emotional reasons, panic, fear, misunderstanding, he sees an opportunity. This approach is deeply psychological. Markets react emotionally, not rationally. Burry exploits that emotion-based inefficiency. 3. His unique view of market cycles. Burry's stocks don't just reveal what he likes, they reveal what he fears. His recent investments have been heavily influenced by his macroeconomic concerns, inflation, asset bubbles, credit cycles, and over-leveraged markets. When Burry believes the world is approaching a recession or financial correction, he steers toward defensive sectors. This is why his portfolio often shows retail with strong cash reserves, consumer staples, energy companies, utilities, agriculture, healthcare, insurance. These are companies that survive downturns. They produce essentials, not luxuries. They maintain revenue even when markets crash. In other words, Burry prepares for storms before anyone else sees clouds. An important point. Burry does not invest based on trends, he invests based on mean reversion. He believes every cycle, good or bad, eventually returns to baseline. So when markets become euphoric, he prepares for fear. When markets are fearful, he begins to look for bargains. Ask yourself, are you preparing for the world as it is, or the world you want it to be? 4. The hidden message in his simple stocks. Here is something fascinating. Burry's stock picks often seem simple. They don't scream genius at first glance. But the simplicity is deceptive. A struggling retailer. A low valuation tech firm. A boring insurance company. A water-related agricultural company. A medical supply manufacturer. A regional bank. But each tells a silent story. This one is undervalued because the market overreacted. This one has assets worth more than its entire valuation. This one will benefit from inflation. This one is recession resistant. This one is tied to essential resources. Burry's portfolio is not meant to impress. It is meant to win. 5. What Burry's recent stock picks reveal. In recent years, Burry's portfolio has shown a pattern. He favors companies with low P/E ratios. He likes companies buying back their stock. He avoids companies drowning in hype. He chooses firms with high tangible assets. He values strong free cash flow above growth stories. He prefers companies punished unfairly by the market. This gives us insight into his current worldview. He believes markets are expensive. He believes many stocks are overvalued. He believes a correction is coming. He believes fundamentals, not hype, will lead the next cycle. If you want to think like Burry, ask yourself: what is undervalued in a world obsessed with the overvalued? What has real value in a world full of illusions? The anatomy of Burry's picks, what his favorite stocks really say about him. Michael Burry's portfolio is more than a strategy, it is an X-ray of how he interprets the world. Every stock he buys, every sector he leans into, and every deeply contrarian position he takes reveals the inner logic of a man who has never been afraid to stand alone. In this part, we dive into the actual structure of Burry's stock preferences, not simply the categories he invests in, but what these choices expose about his worldview, his fears, his predictions, and his unique understanding of financial cycles. And remember, Burry does not invest for the present moment. He invests for the moment no one else sees coming. So what does his portfolio tell us about that unseen future? Let's break it down, uninterrupted and unfiltered. When you study the history of Burry's holdings, one pattern is unmistakable: he consistently buys stocks the market has emotionally rejected but intellectually misunderstood. For example, he has repeatedly invested in cyclical companies at the exact moments when everyone else gave up on them. Why? Because Burry knows something most investors forget: cycles turn, and despair eventually becomes opportunity. In his view, investor emotions create mispricing, and mispricing creates profit if you have the courage to buy when the rest of the world is fleeing. This is why he has invested heavily in beaten-down retailers, distressed manufacturers, and declining financial firms. Burry doesn't care about short-term declines, he cares about long-term intrinsic value. If a company is still generating cash flow and has a stable balance sheet, he sees weakness not as a red flag, but as an invitation. Look at his interest in regional banks, for example. Most investors consider them risky, outdated, or irrelevant compared to modern fintech. But Burry sees something else: real assets, predictable revenue streams, natural monopolies in local markets, and the opportunity to capitalize on overreactions during crises. After the banking scares of recent years, when fear dominated headlines, what did Burry do? He bought. Not because banks were exciting, but because fear was excessive, and excessive fear creates mispricing. It's the same pattern we saw when he purchased shares of companies hit hard by inflation, supply chain issues, or rising interest rates. Burry's philosophy is simple: if the market panic is temporary but the underlying business is permanent, the stock becomes a bargain. Another category that reveals Burry's mindset is energy and commodities. While many investors fled from traditional energy during the ESG and cleantech boom, Burry recognized a fundamental truth: the global economy cannot function without oil, natural gas, and essential raw materials, not now, and not for many years to come. His investments in energy companies signal that he expects supply shortages, geopolitical instability, and inflationary pressures to increase the value of essential resources. In other words, Burry invests in what the world cannot live without, regardless of political trends or market narratives. He looks beyond sentiment, straight at reality. Let's go deeper. Burry has also shown consistent interest in medical and healthcare companies, particularly those tied to essential treatments, medical equipment, and long-term demographic trends. This is critical. Burry likes inevitabilities. He searches for industries where demand is not a matter of taste or trend, but survival. Aging populations, increased chronic disease, rising medical costs, these are not market stories, they are mathematical certainties. And where there is certainty, Burry sees stability. Where there is stability, he sees value. One of the most fascinating aspects of Burry's stock choices is his long-standing focus on companies with high tangible assets. In a market dominated by digital valuations, speculative growth stories, and intangible dreams, Burry prefers the solidity of real-world value: land, equipment, pipelines, factories, inventory, and cash reserves. These are assets that do not evaporate when the hype dies. They hold value even in recessions. They act as protection in downturns. And most importantly, they provide a margin of safety, the core philosophy of all deep value investors. Now consider his investments that relate, directly or indirectly, to water and agriculture. This is one of Burry's most misunderstood positions. While everyone else looked at tech or consumer apps, he studied the long-term supply and demand curves of global resources. Water scarcity, agricultural stress, food supply challenges, these are long-term problems with enormous financial implications. But because the market thinks in quarterly earnings, it ignores slow-moving crises. Burry doesn't. For him, the biggest opportunities exist in the blind spots of the financial world, and essential resources are one of the largest blind spots of all. And what about his surprising investments in tech companies, but only the ones that have been abandoned by the market? This is where his psychological insight shines. Burry understands that when the market loves a tech stock, it overprices it. When the market hates a tech stock, it often underprices it. That is why he sometimes buys tech stocks that have been crushed due to temporary problems, regulatory pressure, negative news cycles, or market panic. These companies often still have strong assets, user bases, or cash reserves. The market overreacts to the downside just as much as it does to the upside. Burry takes advantage of emotional overselling because overselling creates deep value discounts. Now consider this: Burry's portfolio is often heavily concentrated. He does not believe in owning dozens of stocks just to appear diversified. Instead, he focuses on a small number of high-conviction bets. Why? Because owning 40 mediocre ideas is not safer than owning 8 excellent ones. Diversification prevents disaster, but concentration creates wealth. Burry is aware of the trade-off, yet he chooses concentration because he trusts his analysis more than he trusts market sentiment. This alone raises a deep question: do you diversify because it's right for your portfolio, or because you fear being wrong? What does all of this reveal? That Burry's stock picks are built on a foundation of contrarian logic, macroeconomic awareness, and psychological insight. He invests in companies with undervalued assets, predictable cash flow, long-term demand, and temporary market mispricing. He avoids hype. He avoids emotional buying. He avoids everything driven by narrative rather than numbers. His portfolio is a reflection of discipline, independence, and patience, 3 qualities most investors lack. Here's the ultimate question his portfolio forces us to ask. Are you investing based on what the market feels, or on what the business is truly worth? Burry knows his answer. The real question is, what's yours? Michael Burry's portfolio is often described as unpredictable, sometimes even chaotic. But what if the chaos is an illusion? What if, underneath the rapid-fire changes and bold contrarian moves, there is a method so deliberate, so patient, and so mathematically grounded that most investors never even see it? In this final part, we will dive deep into Burry's true investment logic, not the headlines, not the memes, not the simplified narratives, but the strategic DNA that defines his long-term success. Because behind every stock he buys, behind every industry he bets against, behind every surprise quarterly move, there is a philosophy so rare today that it almost feels ancient. And yet, it is precisely what gives Burry an edge in a world driven by instant gratification. As we begin, ask yourself, if the market rewards short-term attention spans, why does someone like Burry, who thinks in years, not weeks, continue to outperform the crowd? Let's uncover that answer. First, let's address something most people misunderstand. Burry does not like stocks the way typical investors do. He does not invest because he believes a company is cool, innovative, or popular. He invests because the math makes sense. Burry studies balance sheets like a surgeon analyzing X-rays. He searches for fractures, infections, and invisible structural weaknesses that others overlook. But he also searches for resilience, hidden value, and underappreciated strength. And unlike most investors who chase stories, Burry chases probabilities. So when people ask, what stocks does Michael Burry really like? They are asking the wrong question. The better question is, what financial conditions allow Michael Burry to like a stock at all? Because if the conditions are wrong, he will not buy. If the valuation is unrealistic, he will not buy. If the risks are disguised or mispriced, he will not buy. And most importantly, if everyone else loves the stock, he will almost certainly avoid it. Understanding this mindset unlocks the truth about his portfolio. Burry likes stocks that are neglected, not loved. Undervalued, not hyped. Tangible, not speculative. Cash flow heavy, not dream driven. So let's uncover the types of stocks he consistently returns to, decade after decade. Consider his long-term patterns. Even when his holdings rotate, certain categories reappear with almost obsessive consistency. These recurring themes reveal what he truly values. Theme number 1: Companies with hard, tangible assets. Burry loves companies whose value can be measured physically, not just theoretically. Think energy producers, miners, agricultural firms, landholders, and manufacturers. Why? Because hard assets survive inflation, currency debasement, and market crashes better than hype-based tech stories. In a world full of unstable money printing, Burry wants things that cannot be printed: oil, copper, farmland, production capacity. These are not glamorous investments, but they are resilient ones. Ask yourself, why invest in digital dreams when physical reality will always be needed? Theme number 2: Companies with high free cash flow and low debt. Burry prioritizes businesses that generate steady, strong cash even during economic downturns. He looks for companies that can pay off debt quickly, survive recessions, fund growth internally, buy back shares cheaply, increase dividends without stress. These companies are often boring, but incredibly profitable. Burry loves boring. In fact, boring companies are some of the most mispriced stocks in the world, ignored because they lack excitement. But Burry doesn't invest for excitement. He invests to win. Theme number 3: Deep value opportunities in ugly or hated sectors. Burry famously said, "The best opportunities are found where nobody else is looking." That principle guides his portfolio more than anything else. If an industry is collapsing, hated by the media, or considered too risky, Burry begins his research. Historically, these sectors include retail collapses, housing market turmoil, regional banks, legacy tech, cyclical manufacturing, disrupted healthcare segments. Why does this work? Because when fear becomes overwhelming, prices collapse far below intrinsic value. Burry waits for this exact moment. Then he strikes. It's the same strategy that made him billions during the mortgage crisis. And it still works today. Theme number 4: Companies with insider buying. Burry pays very close attention to management behavior. If executives are buying their own shares, large amounts, with their own money, Burry sees it as a powerful signal. Why? Because insiders only buy when they believe the market is wrong about their company. Burry loves when the market is wrong. Theme number 5: Companies with temporary problems, not permanent ones. Burry distinguishes between companies in decline, companies in temporary trouble. Most investors confuse the two. Burry does not. He searches for companies experiencing fixable issues, cyclical downturns, temporary earnings pressure, supply chain problems, or misjudged short-term risks. These companies are often oversold, unfairly punished, and mispriced. Burry buys them while others panic. Then he holds until the recovery is complete. Theme number 6: Companies whose valuations make no sense. Burry has a talent for finding stocks priced far below their real worth. Sometimes these stocks are ignored. Sometimes they are misunderstood. Sometimes they are victims of short-term fear. But the key is this: Burry does not care what a stock used to be worth. He only cares what it should be worth. And when the gap between price and reality is large enough, he buys aggressively. Let's address something crucial: Burry does not invest emotionally. Ever. Many investors buy stocks because the company inspires them, or because they believe in the mission, or because they feel optimistic. Burry does not care about any of this. His portfolio is built on intellectual honesty. His portfolio is built on intellectual honesty. Pure, unsentimental reasoning. Cold analysis. If the numbers are wrong, he stays away. If the hype is inflated, he stays away. If the crowd believes something without evidence, he bets against them. He once said, "If you're not willing to bet against the crowd, you should not invest." That mindset drives everything he does. It's why he bought credit default swaps when the world laughed. It's why he repeatedly shorted index funds during market bubbles. It's why he invests heavily in sectors everyone else avoids. Do you see the pattern? Burry's secrets aren't magic. They're discipline, patience, rationality, and a willingness to think independently in a world terrified of being different. Today, Burry's portfolio continues to evolve. He still rotates quickly when macro conditions demand it. He still makes controversial bets. He still takes large positions others consider too risky. But beneath the movement, beneath the noise, the same principles remain. He buys value. He avoids hype. He studies risk with surgical precision. He stays patient. And he positions himself where future mispricings are inevitable. With every trade, Burry is asking questions the market refuses to ask. What if the crowd is wrong? What if the danger is invisible? What if the opportunity is where nobody else is looking? What if the obvious bet is actually the most dangerous one? These questions define his career. They define his portfolio. And they define why he continues to outperform even in a world dominated by high-frequency trading, algorithmic predictions, passive funds, and social media sentiment. So here is the real takeaway: Burry doesn't like stocks. He likes mispriced reality. He likes mathematics that contradict emotion. He likes situations where human psychology creates inefficiency. He likes markets where fear or greed distort logic. He likes environments where he can stay calm while everyone else panics. And that is the true secret behind his portfolio. Not the names. Not the sectors. Not the positions. The philosophy. The discipline. The courage to think differently. As we close this documentary, ask yourself one final question, because it is the same one Burry silently asks the market every day: if everyone else sees the same thing, who is truly seeing nothing at all? And that brings us to the end of this deep dive. If Michael Burry's story teaches us anything, it's that independent thinking is still the most powerful tool an investor can have. The crowd may react, but visionaries act. If you enjoyed this documentary and want more content that challenges the mainstream narrative, don't forget to subscribe and turn on notifications. Join us, stay curious, and keep questioning the markets. See you in the next episode.